And on that point of prenups, number 9 is about who you marry.
Yeah, this is a tough one. It's a tough one because,
I mean, this is front of mind for me because, as you can see from these photos, I just proposed to my fiance.
Yeah.
And I mean, this is not the ring, but because this is a bit extra. But
that's awesome.
Oh my God, the team put my face in the box. That's creepy. But yeah, so why is this so important, who you decide to marry, as it relates to how rich you'll be or won't be?
Well, it's not just how rich you'll be, it's how satisfied you'll be with your life and with your marriage. Academic research has identified 2 spending profiles that you can categorize people into. One is tightwads. It's people who don't like to spend money. And one is spendthrifts. That's people who do like to spend money. The names are kind of funny, but that's what the research calls them. And the crazy thing about this is that tightwads and spendthrifts are more likely to end up marrying each other than to marrying someone who has the same profile as them. So a tightwad and a spendthrift are more likely to get married than a tightwad and a tightwad, or a spendthrift and a spendthrift.
What do you think that is?
The research on this talks just about kind of opposites attracting, and there may be some sort of thrill to the differences initially. But tightwads and spendthrifts, as they go through their marriages, do tend to be less satisfied in their marriages and have more marital conflict around money. And again, that's based on an academic paper.
Now that's reasons why the marriage might not last, but in terms of how it might impact your financial success.
If you really want to save, if you go through your goal setting exercise and your PERMA model, and you have a vision for the life that you want to live that requires saving, and you have a spouse that wants to spend a lot of money today, that can be very, very difficult. It can make it a lot harder for you to achieve your goals. I don't think it's insurmountable. I think a tightwad and a spendthrift can work. I mean, it's not like all of them end up getting divorced, but it does require a different level of coordination and communication and being on the same page.
Do you have to speak to clients about this often?
It comes up a lot. We have lots of clients who were single and end up getting in relationships and then getting married. And we have to all have all kinds of conversations about marriage contracts or prenups, estate planning.
Do you think everybody should get a prenup? Going back to what you said earlier, where you said you if you don't write your own, the government will give you theirs.
Yeah.
Which, just to simplify that, if you don't write your own prenup, then the default position is the government will decide through the law how your assets are divided at a time when you break up. Problem is, people find prenups to be really unromantic.
That's right.
And they also think there's an implication that we're assuming we're going to break up, which is also not so sexy.
Right.
Do you think people should get them?
If both partners are on the same page and comfortable with it, it's not going to cause a major rift. And if it does, maybe that's a red flag.
Do you know what I mean? Why would it cause a rift?
Yeah.
Do you know what I mean? And it's not to say that I'm just keeping all my stuff and you're keeping yours. It's just to say, let's agree now what would happen in the 50% probability that this doesn't work out.
Yeah. We've seen both. We've seen clients come up with very creative and interesting marriage contracts that have, specific formulas for how things are going to work. And depending on how many kids they have, it's kind of an interesting exercise. And in that case, it was kind of fun. And they were engaged in the process and it didn't cause an issue. And we've also seen people who did not have anything in place and have had very bad divorce outcomes from a financial perspective.
Oh, I had a friend go through a divorce recently, and he's a very successful person. His wife was there from the beginning. She looked after the family while he was off gallivanting around the world, building his businesses all over the place. So obviously she's contributed hugely to his success. What I noticed though is it's destroyed what could have otherwise been a good relationship as they separated. They now really, really hate each other because lawyers have stood in between both sides and basically caused tension because that's their job. They're going to get paid more. And her lawyers are incentivized to squeeze every single penny they can out of this separation. And so I think he said it had been like 6 or 7 years since they decided to divorce. And he's still in court arguing with lawyers about how they separate. And it's destroyed their relationship. And they've got 2 kids. You just think, gosh, if you had a prenup, this would have been quick and it could have saved the relationship. Okay. Anything else to say on this point of marriage and compatibility?
The academic research on this does have a short quiz. I don't know if we have it kicking around anywhere here.
I think this is it. It's called the Tightwad and Spendthrift Quiz, developed by researchers at Carnegie Mellon and the University of Michigan.
Yeah.
This scale measures the pain of paying, the emotional distress some people feel when spending money. And here's a quick DIY version of that quiz. Question number 1 is, you see a high quality coat on sale for $100, which is usually $300. You need a coat and you have the money. Do you buy it? Answer A, no. $100 is still a lot of money. I'll wait for a better deal. B, yes, it's a great value. I need something. C, yes, and I might buy a scarf to match since I save so much. Which one are you?
I mean, if I need the coat, I'm B.
I think I'm C. But actually, to be fair, I just don't buy stuff, so I don't even know if I'd buy it anyway. Question 2. You are at a restaurant with friends. The bill is being split evenly, but you ordered the cheapest item. How do you feel? A, physically pained. I'll likely mention that I should pay less. B, a bit annoyed, but I'll pay it to keep the peace. Or C, fine. It all will even out in the end.
I'm between B and C.
Really?
I might feel a little bit annoyed.
Really?
But I wouldn't cause a fuss about it.
I'm C again. Fine, it'll even out in the end. Number 3, which statement describes you best? A, I have trouble spending money even on things I actually need. B, I balance my spending and saving pretty well. Or C, I often spend more than I intended and regret it later.
I think I'm B.
You said B, which is I balance my spending and savings pretty well. I would say I'm C again. But again, the caveat here is I actually I don't spend money on stuff anymore. I don't buy stuff anymore. But I can spend it on like travel and experiences and stuff.
Yeah.
Last question. When you buy something expensive, your primary emotion is A, anxiety or regret, B, satisfaction in the utility of the item, or C, excitement and a rush.
I think I'm B again.
I reckon I'm B as well there. So scoring your results. If you're mostly A's, then you're a tightwad. If you're mostly B's, you are the unconflicted. And if you're mostly C's, you are the spendthrift. So I guess with that, you are a unconflicted. You're in the middle. You have a healthy relationship with money where you can save when necessary, but enjoy the fruits of your labor without guilt. And I am a C, which is you feel very little pain when spending. You enjoy the moment, but you might struggle with long-term saving goals or buyer's remorse. That's so fucking true. Everyone should do that at home. Okay, that makes sense.
So we know that tightwads and spendthrifts are incompatible. I do think it's an interesting concept. Like, how do you have that discussion with a potential partner? Or do you just observe it and kind of infer?
On a date, you can say to your partner, say, oh, there's this great podcast on YouTube called The Diary of a CEO. We should listen to it. Then listen to this episode. They're listening with you right now if you've done this. And then just play along with your partner at home. Are you looking for your partner to be the opposite then? Because you said opposites attract.
No,
they don't do well over time.
No. Opposites end up together, but then have conflict because of that.
Oh, okay.
Yeah.
Interesting.
Yeah. I think if you're a tightwad, being with the same is probably good. If you're a spendthrift and you end up with another spendthrift, I think you have to be really careful about your household finances.
Yeah. I don't think my partner's a spendthrift. I think she's in the middle with like you.
Yeah.
Doesn't really care.
Yeah.
Which is useful.
We do have one more
okay
card in the mistakes, which is underinsuring catastrophic risks. And I think that's one, particularly for people who are not currently financially independent, that's really, really important. If your household income relies on your income to maintain the lifestyle of the household, it's really important to have sufficient life insurance where if you die, your human capital, your ability to earn income in the future is replaced by the insurance, and also disability insurance, where if you lose your ability to work, you have insurance to replace that income.
Do many people think about this?
Probably not enough. And it's cheap. Well, disability insurance is not always cheap. Life insurance is generally pretty cheap if you're buying low-cost term life insurance, which is what most people need.
You made a video called The Most Controversial Paper in Finance.
Yeah.
What paper was that?
That was a paper, we didn't have it out here, but that was a paper on life cycle asset allocation.
What does that mean?
So it's answering the question of how should your mix of stocks and bonds change throughout your lifestyle? Conventional wisdom says that you should start out riskier in stocks and then move towards safer bonds as you get older. This paper took a huge amount of data. They had data from 39 countries going back as far as 1890, I believe. They sampled from that large set of data to simulate a million potential sort of hypothetical lifetimes that you could live through. And then they asked the question of, in this simulated data, which asset allocation gives the best outcomes? And they tested target date funds, which increase the weight in bonds over time. And those are, a lot of people have those through their retirement accounts. So it's just one fund, and it starts out when you're younger with more equities and then transitions to bonds over time. That's a target date fund. They tested, I believe, a 60-40, 60% stock, 40% bond asset allocation. There might have been some other stuff in there too. They might have tested only domestic stocks. And what they find in this paper is that the optimal portfolio from the perspective of retirement consumption utility and bequest utility.
What does that mean?
It's like the satisfaction you get from retirement spending,
Okay,
measured with a formula so that it can be studied. And then likewise for the amount of money that you have left over at death. They measure the probability of running out of money, as well as a whole bunch of different metrics they look at. And they find that a 100% equity portfolio with a big chunk in international stocks is optimal. It is a 1/3 domestic, 2/3 international stocks.
When you say domestic, what does that mean?
That's a great question. So the way they set up domestic in the paper is that it can be any country. So the way they do the simulations is that for each draw, so they're drawing, it's on average 10 years of returns. Or say we're in the US. They'll draw the US returns measured in US dollars for a 10-year block. That's the domestic return. And then the international block is going to be 10 years on average of all the other countries' samples returns measured in US dollar. So I've got the domestic return, the international return. The next block might be 10 years from Italy, measured in whatever the Italian currency was at the time. And then the international portion is going to be all the other countries, excluding Italy, measured in Italian currency. And so they're weaving together all these blocks. That's called bootstrap simulation. So domestic, to answer your question, is whatever country you live in.
So the outcome or the conclusion from this should be that you should invest, I mean, if we're following this and if it was 100% accurate, 60% in whatever country you live in the stocks of whatever country you live in?
30%.
30%.
Domestic. So yeah, 1/3 domestic, 2/3 international.
Okay, so if I'm in the United States, so I get 30% of my capital and invest it in the American companies.
Yeah.
And then 60% in international stocks.
Yeah. Well, so yeah, 67%. Yeah. Yeah. So that one important finding in the paper, and I talk about this in the video, is that the curve for how optimal the domestic amount is pretty flat, if I remember correctly, between sort of 10% and 50%. So they do say in the paper that for a US investor, you don't necessarily have to be 1/3 domestic. Even if you're 50 or even if you're just market cap weighted, which is currently around 60 or 65%, that's probably fine. But for a Canadian investor or someone who's in a country other than the US, 1/3 in your domestic country ends up being a pretty big home country bias.
In these simulations, are they saying that you need to invest in international stocks? Because sometimes in the simulations, your domestic country, your home country, has problems.
Yeah. High inflation tends to be bad for retirement consumption, that you're spending a lot more, and for domestic stock returns. And international stocks protect against that.
So it diversifies you a little bit.
Yeah, well, it's exactly what it is. It's a diversification. And that paper, was controversial. I mean, we had the co-author on our podcast twice to talk about it, but it was met with a lot of controversy from everybody, from a lot of professionals, from other academics.
Why?
It's an extreme finding. The conventional wisdom that you should be allocating more toward bonds throughout the life cycle is so ingrained in everyone's thinking that a finding like this that shows that that's basically wrong, of course it's going to be met with controversy. But at the very least, I think it's an interesting paper. It's telling us that stocks are a little bit safer for long-term investors than we probably thought. And bonds, which are typically considered safe, are actually a little bit riskier than we may have thought for long-term investors. The reason being that during periods of high inflation, bonds get absolutely decimated.
What's a bond?
A bond is a debt instrument. So you're effectively lending money to a government, and you're receiving interest payments over time, and then your principal back at the end.
What is the most important thing we haven't talked about that your audience come to you to understand?
Oh, well, a lot of the things that I talk about are financial products that you should not invest in.
Okay, tell me some of those.
Which I always think is fun. A big one that I spent quite a bit of time on last year, I did 3 videos on it, was on covered calls.
What's that?
So that's where you own a stock and then you sell a call option, which is the option to buy the stock. You're selling that option to somebody else, which gives you an option premium. And so you get some income from having sold the call option. But it also means that if the stock that you own appreciates sufficiently, you are required to sell it to the person who bought the call option from you at a preset price. So the stock's whatever, $40, and you sold a call at $50, and the stock goes to $60, you have to sell it at $50. Mm-hmm. So you're giving up a big chunk of your upside. And this plays on one of the big biases that investors have, which is a preference for income. It's the mental accounting bias, where investors separate capital and income. And so there's a huge proliferation now of covered call products where they do that strategy that I just described inside of an ETF. And they charge usually a higher fee. And these are being marketed really heavily to investors on the premise that you're going to get appreciation, capital appreciation, and you're also going to get income. But I think my view on this, and what I tried to explain in those videos, is that you're giving up so much upside that I don't think most investors realize that they're giving up, that the implied cost of these products is enormous.
On that point of fees, I've got this graph here, which I think is pretty pertinent to what you're saying. Because when we start investing in ETFs and various index funds, we often don't think about fees. It'll say, 0.5%. We think, okay, whatever, 0.5% is fine. 1% fine. Small numbers. But when you look at that graph, you see how that can impact your outcome over time.
Yeah. Fees compound. Any rate of return that compounds over long periods of time can be very impactful in dollar terms. Yeah.
And some people choose to keep their money in cash because most of us are never educated on this subject of inflation and what inflation means. So some of us, we might keep $10,000 under the bed. What do you say to those people?
Yeah, so inflation it's everywhere. It's been around for throughout history, and it's probably not going to go away. We have central bank policies in most developed countries that actually target a low but stable rate of inflation. And there are reasons for that, but what it means is that if you have money sitting under your mattress, its purchasing power will decrease over time. And that can be very damaging to your wealth. You can maybe keep pace with inflation using short-term government debt instruments, which are going to pay you a little bit of an interest rate. But again, periods of high inflation can cause even that to decline in real value. So one of the best ways to fight inflation for long-term investors, something we've been talking about, is just investing in low-cost index funds to avoid the fee issue and participate in the stock market, which throughout history has far outpaced inflation.
If you love the Diary of a CEO brand and you watch this channel, please do me a huge favor. Become part of the 15% of the viewers on this channel that have hit the subscribe button. It helps us tremendously, and the bigger the channel gets, the bigger the guests.